Well, it seems like it did not take long into 2024 to get the Fed to give us a rug pull. Classical Fed rug pull. In this video, we're going to get into what the Fed just did and said that has stocks selling off big time today, and what could be to come in our markets. The Fed Minutes starts off by saying on page 4, quote, over the intermeeting period, some softer than expected data releases appear to lessen the perception among investors that policy may need to tighten further in order to bring inflation down to 2% over time. Market participants also viewed monetary policy communications on balance as pointing to somewhat less restrictive policy than expected. As a result, nominal treasury yields declined significantly, and the expected market implied path for the federal funds rate beyond the next few months shifted downwards, going from 4 rate cuts to 7. Meanwhile, broad equity prices index were boosted by many of the same factors that lower treasury yields, and spreads on investment and speculative grade corporate bonds narrowed. Financing conditions remain modestly restrictive as borrowing costs remain elevated despite declining over the intermeeting period. Now, they go on to say, to even reference the S&P 500, they say broad stock price indexes increased markedly over the intermeeting period, and spreads on investment-grade bonds narrowed modestly. While those on speculative-grade corporate bonds declined more notably, the one-month option implied volatility on the S&P 500 decreased moderately and reached its lowest level since January of 2020. They say bank credit conditions appeared to tighten somewhat over the intermeeting period, but credit to businesses and households generally remained accessible. They say credit conditions for small businesses appeared to have tightened further in recent months. Credit quality remained broadly solid but deteriorated further for some sectors in recent months. The delinquency rate for small business loans continued to tick up in September and was above levels observed just before the pandemic. Credit card delinquency rates also increased further, while delinquency rates on auto loans were little changed in the third quarter. So what you're noticing here is the talk about rate cuts is really gone. They're not talking about rate cuts pretty much at all anymore. The Fed says the risks around the forecast for economic activity were viewed to be tilted to the downside, so we have a greater chance of seeing bad data than good data. In particular, the additional monetary policy tightening that could be put in place if upside in inflation risks were to materialize, with the potential for a greater tightening of financial conditions represented a downside risk to the projection for economic activity. So basically saying if factors in the economy do not continue to improve, they might be forced to raise rates and put more pressure on the economy. Regarding the economic outlook, participants generally judged that in 2024, real GDP growth would cool and the rebalancing of the labor market would continue, with the unemployment rate rising somewhat from its current level. Retail sales growth had stepped down noticeably in October, though a few participants remarked that contacts reported strong sales in November, notably related to holiday spending. Participants mentioned several factors that may contribute to softer consumer spending, including slower growth of labor income and diminishing pandemic-related excess savings. As evidence for the soft landing of the growth of labor demand during 2023, many participants noted the decline in job openings, and a few remarked on the lower quits rate. Several participants noted that the risk that if labor demand were to weaken substantially further, the labor market could transition quickly, keyword quickly, from a gradual easing to a more abrupt downshift in conditions. They're basically saying that if things start to snowball, it could go quickly, and by that you could rapidly enter a recession. Participants generally perceived a high degree of uncertainty surrounding the economic outlook as an upside risk to both inflation and economic activity. Note, they're saying inflation and economic activity. They're still not dropping inflation. Furthermore, participants observed that after a sharp tightening since the summer, financial conditions had eased over their intermeeting period. Many participants remarked that an easing in financial conditions, bond yields, what is appropriate, could make it more difficult for the committee to reach its inflation goal. And last but certainly not least, participants discussed several risk management considerations that could bear on future policy decisions. Participants saw upside risk to inflation as having diminished, but noted that inflation was still well above the committee's longer run goal and that a risk remained that progress towards price stability would stall. A number of participants highlighted the uncertainty associated with how long a restrictive monetary policy stance would need to be maintained, and pointed to the downside risk to the economy that would be associated with an overly restrictive stance. A few suggested that the committee potentially could face a trade-off between its dual mandate goals in the period ahead. Now, I've heard some analysts and investors say that this is actually a good thing, and it's not. I mean, a trade-off between what? Price stability or maximum employment? What, you're going to let inflation rise and maximum employment stay low, or what? You're going to let maximum employment ease, meaning people lose their jobs, and inflation continue to fall. A trade-off either way is not good. That's specifically not good when our markets have been trading based on a narrative that we're not heading into a recession in 2024. The summary of the Fed minutes today was less rate cuts, potentially a hard landing, and maybe the Fed will need to raise rates again. If not, keep them higher for longer. None of that sounds good for stocks. But here's where things get a little bit tricky, because 10-year Treasury yields actually fell about 2 basis points today, and the markets are still pricing in 6 rate cuts for 2024. So the Fed kind of rug pulled the markets today. And the fact that the S&P really stocks broadly, trading near all-time highs, really puts a lot of pressure on the markets to the downside. That's why we've seen an over 2.5% drop in the Russell 2000 today. The Russell 2000, your small mid-cap stocks, your interest rate sensitive names, are by far the most affected by less rate cuts, greater odds of a recession, and, well, inflation remaining too high for too long. So one thing that I think is very important to understand is the only thing that really matters to the markets is a recession or not. But more specifically, the direction of the economy itself. You can have an economy that's doing well, that's rising, like wages rising and GDP rising. The economy overall doing well. You could have a sideways trading economy that really isn't doing much. Or you could have an economy that is tilting downwards. Tilting downwards, in simplistic terms, is very bad for markets. Think about 2022, that August through October sell-off. That happened because why? The Fed was going to be higher for longer. After all, inflation was not falling as quickly as a lot of us were hoping, and the odds of a recession were rising. Some of your key data points were also looking quite negative at that time. So stocks, in essence, sold off because of fears of a recession. Not that we were actually in a recession already, because we were not at that time. And then 2023 was really categorized as inflation falling faster than expected, the economy holding up, and ultimately not seeing the foreshadowed recession that economists were calling for in 2023. But there was still this fear out there that we could go into recession. That's why Magnificent 7 stocks did so well, because if you have to be allocated to stocks, if that's your mandate as a fund manager, well, what better place to be than Magnificent 7 names? Google, you can make an argument that Google would actually make more money during a recessionary environment because companies are going to advertise more to try to keep up their growth. You can make an argument that companies would opt to use Azure cloud products, that is Microsoft's AI software services, because maybe it makes their business more effective. They can lay off other employees somewhere else throughout their business. You could make an argument that Apple would not be affected as much if we were in a recession because a lot of people get iPhones via promotions with their phone providers, right? You can make an argument that would have been the best place to be in the markets, whereas 2023 was a pretty rough year for your average stock. See, that context is important for where we go ahead next in our markets, because 2024, it's still a coin toss whether or not we get a recession. About 45% of economists think we will head into some form of recession in 2024, but the markets recently, the broadening out, the rally in small cap stocks has been saying otherwise, that we're probably going to avoid a recession. But the higher the Fed stays for longer and the more committed they are to inflation and making sure it continues to fall under 2%, even though if you look at 6-month annualized PCE, you're at 1.9%, you're literally under 2%. 6 months from now, if trends continue, you will be under 2% inflation. The Fed doesn't even care about that. At least it seems obvious now that they're more concerned with inflation than they are avoiding a recession. So the big question is, if we start to tilt downwards in the economy, if we start to really boil this down, if we start to lose jobs or job creation starts to really slow down, potentially even starts to look like it might go negative, that's where you will get a massive, not a small, but a massive sell-off in our markets. And I think that's what happened today in small cap stocks. Small cap stocks are specifically susceptible to recessions because they don't have the cash reserves. They need to raise debt. A lot of those markets, credit markets, are going to dry up for small cap stocks if we do go into a recessionary-like environment. IWM, the ETF for small caps, was down 2.67% today. Whereas, again, 10-year treasury yields actually declined by 2 basis points, and the odds of 6 rate cuts did not move today. The odds of 6 rate cuts actually rose following the Fed minutes. Yesterday, odds of 6 rate cuts was 39%. 39.0%. The odds today, 39.2%. So you're actually pricing in a little bit greater odds of more rate cuts today following the Fed minutes. So I think this fear was really the Fed is going to be too high for too long, and or the Fed is ultimately waiting until the economy goes into a recession to start cutting rates. That the Fed is going to be, well, they were too late to start raising rates. The Fed's going to be too late to start cutting rates. We are going to get the typical cycle that we get with the Fed. Fed raises rates, we go into a recession, aka the hard landing. I think that's what really affected markets today. But that does not mean definitively that's what is going to happen. You could see inflation continue to fall. You could see the economy continue to hold up and kind of just tread waters sideways, if you will. We don't have to go into recession. That's why the upcoming economic data is going to be so important. The problem I see with the markets right now is the markets want clarity. Are we going into a recession or are we not? We can get this clarity in really 2 ways. The economic data itself, which is most important, but also company earnings, which earnings are going to start January 24th, for Tesla, for your big tech names, and go all the way through the month of basically the first 3 weeks of February. So we're going to get some clarity there, how companies are doing, and that will be important. Now, coming tomorrow, you will get the first big data report on the economy, specifically on the labor market. Now, just to be precise, your big labor market data is on Friday with the non-farm payrolls. But you will get the ADP employment change. So the ADP employment change is the private payrolls from, private institutions, right? From the ADP itself. Whereas the non-farm payrolls is from the government. So 2 different organizations that put out their own employment numbers. Now, your ADP employment change, it's not as important as the non-farms, but it will tell you about what the non-farms might look like. So ADP employment change is actually expected to rise month over month from 107,000 jobs in November to 115,000 jobs added in December. So you're actually expecting a month over month increase to the ADP employment change. If that happens, that's going to be great news for stocks. We're going to get that data coming out at 8:30 or 8:15 in the morning tomorrow, Eastern Standard Time. So before you can even start to trade stocks, that data will be released, and that'll set us up for Friday's big data, which will be the non-farm payrolls. And you're actually expecting that to fall from 199,000 job ads in November to 168,000 job ads in December. 160,000 job ads is the historical average of the U.S. economy. If you start to fall under this, if you start to go under 140, under 120, ultimately under 100, that's when you get a big sell-off in the markets in anticipation that you could see, as the Fed said, a rapid deterioration of the labor market, which would ultimately lead the economy into a recession. On Friday, you will also get ISM Services PMI, as well as some smaller data points as well. But the markets, they're really going to move based on the non-farm payrolls report. So really, to bottom line this, as stocks are trading near all-time highs, only off of all-time highs by like 2%, what we need right now for a continued rally in the markets is clarity, better understanding of where the economy is at, where earnings are going to be at. Ultimately, that'll tell you where valuations are at based on the earnings picture and where valuations should be based on the economic cycle that we're currently in. Is the economy expanding, recent data reports would suggest? Or are we at the end of a cycle and potentially heading into a recession? That's going to mean a lot for our markets. Ultimately, that's going to mean everything for our markets for the next 6 months or so. But unfortunately, based on my opinions, we're not going to have enough definitive clarity until we have the non-farm payroll report, until we have retail sales data, until we get more inventory data, the kind of the core things that make up GDP itself, and big tech earnings out the way, which is going to be really 1 to 6 weeks from now. So the first quarter of 2024 could shape up to be a rough quarter. The second quarter, well, if the recession narrative does play out, the second quarter could probably be the worst quarter of 2024. That could inevitably set you up for a strong second half of 2024, especially as we get clarity on how the economy is doing, whether or not we're heading into recession. If we are heading into recession, how deep is it going to be? Potentially, how long could it last? What's the unemployment rate going to go to? So on and so forth. And then the Fed, by that point, is going to be aggressively cutting rates to offset that. Or do we just avoid a recession? Economy, again, trudges along sideways, maybe even expands. Who knows? We've seen crazier things happen. And then by that point, we're getting rate cuts anyways, because inflation, likely, if trends continue over the next 6 months, you're going to be under 2% PCE. So which one ultimately plays out here? I don't have a definitive answer, but I want to be a little bit more defensive right now, at least until we get Friday's non-farm payroll number. Once we get that non-farm number on Friday, we're going to have a little bit more clarity, and I think the markets can make a larger move to the upside or the downside based on that number. Again, anything higher than 160 is going to be really good news for markets. 160,000 job ads. If we come in like 180,000 job ads, that's awesome because the economy's holding up. People are still hiring. If unemployment, goes up or down a little bit, not a big deal as long as it doesn't move too big, to the upside especially. Unemployment falling, that's great. Soft landing picture is fully intact at that point. If you get a number that's under 120,000 job ads, you likely get some weakness in the markets. If you get a number that's under 100,000, under 80,000 job ads, you could see a rapid crash, if you will, in our markets. Probably 2 to 3% of a downside move coming on Friday alone. So let me know what you think about all of this information down below in the comment section. Hit the like button, consider subscribing to the channel as well if you like my perspective, if you like the deep dives we do on these topics, trying to estimate and guesstimate where the markets are going to go next. We strive to be as correct as possible here on this channel. We'd love to have you along for the ride as well. Share your opinions down below in the comment section. Most importantly, enjoy the rest of your day and night, and I will see you in the next one.